So we have a panel here, and I'd like to introduce our panel. It's to continue this theme of growing your business through acquisition. So a gentleman who probably doesn't need any introductions. What's his name?
Richard.
Yes, Richard Jarratt. Okay, Richard Jarratt they have a sheep plant down in Bristol, SH Fiske, and he has acquired several businesses over the years as part of their strategic growth plan. So that's why Richard is on the panel from a sheep plant's point of view. Next in line we have Nick. I've not actually met Nick before, but Nick Mockett of Moorgate Capital, who are mergers and acquisition experts specialised in the European packaging industry. Is that about right? Will that do? Yeah, great. Next along, we've heard from him before, Jason Milkins from Roxburgh Milkins. As you know, they're the SPA's retained contract lawyers, and amongst other things, specialise in corporate transactions and are regular presenters here. And finally, Tim, another gentleman I've not met before from River Evolution Partners, who are investors with interests in the UK packaging industry. So he's got some money and is looking to buy someone from our industry. Is that about right?
Just about.
Yeah, okay. We've cut through all the pretense, so that's great. So I'm going to start. We put an email out. You may have received it. We were asking for some questions. You know, what do we ask the panel about growing by acquisition? So we're going to crack on. We'll start with Richard first, if that's all right. Richard, can you talk us through how you've benefited by buying several businesses, and what were the benefits that were gained by both parties in the process, and did you involve outside help in that process?
Okay, well, thank you, Tim. Can you hear me, everybody? Yes. Yeah, fantastic. When I listened to the thing about people selling for £20 million or £2 million or something like that, I thought, really, I'm going to be a fraud, because all the I won't even call them acquisitions, all the deals that we've done over the years have been in the sort of 150,000-ish sort of level. And as a result, every single one of them has been buying assets and goodwill. And I'm terribly sorry to say that as a result, only one of them has involved the legal profession. And the reason for doing it has been really simple things, twofold. First of all, it was an opportunity to get us into a market area that we weren't previously in. And so for the first and only time ever, we bought the trade and some of the equipment and some of the staff of a company that it was a mini Swan line, I don't know, 20, 30 years ago. And we got ourselves into mounting prints onto bits of cardboard. And I'll come back to that in a minute. A couple of other times, a local manufacturer has said, I'm getting on a bit, haven't got any succession, don't know what to do with the business, can we do a deal? And so we did a deal on that sort of basis. And the reason for us doing it is, A, it gets into a different market area, which we wanted to get into, and B, it gets us some fairly inexpensive sales, because we get the sales book, and C, it gets us, with a bit of luck, a bit of kit that does something that we couldn't previously do, that widens our overall offering. So that's worked for us. It's all been, I say, very, very small beer stuff, and because we have been basically buying a pile of stock, which we can agree a value on, and we've been buying a few machines, which we can agree a value on, that's almost like selling boxes. You know, you send the bloke an invoice, or correction, he sends you an invoice and you pay it. And then we did an earn-out deal for the goodwill, and again, that's an agreement between two people that was very straightforward. So we took the view that because we weren't buying shares, we were only buying physical assets and we were buying goodwill, we could just go ahead and do it a bit like buying a machine from a machinery supplier. And I say, so far, we haven't been caught, and we've lived to tell the tale. However, it sounds simple, and we got a bit cocky on one of these deals, and it was the mounting business. And so we bought this business from a liquidator, and because it was an area that we knew nothing about, we took on the ex-owner of the business, and we also took on 3 or 4 of his staff, plus a bit of machinery and all that sort of stuff. And there we are, we're in the mounting business, chaps, and it's going to make our fortune for us. One thing that we are good at is monthly accounts. We do know how many beans make 5. And we couldn't, for several months, work out why the material content of this newly acquired business, from month to month, went up and down like a Western donkey. One month it'd be 40%, oh, we made a fortune. The next month it'd be 60%, oh God, where it's all gone wrong. And so we started thinking, well, maybe it's an estimating error, because the sort of mounting we were doing, it was very easy to either charge twice too much or half as much as you should do, because it's one of these things where you get 2 out and it's this and that and the other, so it's very easy to make an arithmetic error. So we looked at that, not the answer. Could it be that our supplier was short supplying us on this new material that we were buying? So we went and had and checked everything. No, that was all in order. Could it be that we were paying the wrong price on the purchase invoice? All the standard stuff we looked at. Were we scrapping more of this in production because we had a machine fault? We couldn't get to the bottom of it. Until about 6 months in, somebody snitched. And the fellow that was the previous owner of the business was restarting his business on Sunday afternoon in my factory using my machinery, my stock, and paying my then staff in cash. So anyway, he was invited with his staff to go and make alternative arrangements. That was the easy thing. The bad news thing is the bloody business still exists. So anyway, so the only word of advice I would have is, it looks simple, it sounds simple. For God's sake, don't believe everything you're told. Do check on the due diligence bit. We've done all our own due diligence in these things. So, do and say, I'd like to see an invoice. I'd like to see how the estimate was done. I'd like to see a purchase invoice from whatever it is. And go back, it's just the sort of standard auditor stuff. But most of all, trust what you've done and trust the people that are now doing it for you, but for bloody well check. And then think the unthinkable, because unfortunately we've found that not everybody's moral compass is pointed in quite the same direction as ours is. So, check that as well. But at the very low end of acquiring things, they were all fairly painless. The integration was fairly straightforward because we're talking about tiny little bits, and the amount of money we spent was sufficiently modest not to spend a similar amount on our legal and advisory friends down the end here. So that really is it. End of story.
Thank you, Richard. So I guess if you were going to go and buy a company with all its shares, you would use the skills of a professional to get that done for you.
Oh, absolutely, no question about it. Yeah, because I think you're right. There are all sorts of skeletons and black holes and things that people either have forgotten that they're there or are purposely going out to try and cover up. So
fantastic, thank you, Richard. So next question, if you can pass the microphone, we'll do these in order. That will be logical. I introduced Nick Mockett to you from Moorgate Capital. Experts specialise in the European packaging industry on mergers and acquisitions. So I've got a question for Nick. Nick, can you talk us through your experience of acquiring and selling businesses in the packaging industry, and what are the benefits and perhaps pitfalls you've experienced, and why engage with a professional service provider such as yours?
Thank you very much. Sorry, this one. Yes, I'll do that. RSI. Was that on the health
You
and
can
safety
take it off
list?
now, I think. Now it's on,
Okay.
that's okay.
It is now.
Marvellous. Thank you. So I've focused on the packaging industry exclusively for 25 years, since I was 1.5, advising on buying and selling companies. Probably slightly more than 50% of the time we're advising on the sell side, and conversely just under 50% of the time advising on the buy side. And our clients are both strategics, so that would be somebody like DS Smith or Jefferson Smurfit, and also private equity funds and what's called financial sponsors. It could be a classic private equity fund, or it could be a a family office. So someone like the Rousings, they have a family office, the people that set up Tetra Pak. When you're doing deals, whether you're buying or selling, you quite often find that the counterparty is either a private equity house or a strategic. And if you're running a sale process, a sale auction, where you have more than one bidder, which is the normal way to sell a company, you may have both in the process at the same time. And they need treating slightly differently. For example, with the strategic acquirer, they understand the industry, so you can more or less take that as a given. But if you're selling to private equity, you quite often have to educate them. And we all know, don't we, in this room, that not every part of the packaging industry is the same as every other part of the packaging industry. Some have a completely different supply curve, some of them have different capital requirements. And when it comes to the financial aspects of the industry, when you're talking about valuing a business, you quite often, we heard a bit about this earlier, valuation is quite often based on a multiple of profits as a proxy for cash flow discounting, which is far too long-winded and boring for anybody in this room to care about. But what we typically talk about when we're buying or selling packaging companies is an enterprise value, which is a multiple of the EBITDA, earnings before interest, tax, depreciation, and amortization. So when you're getting ready to sell your company, you need to be doing quite a bit of preparatory work to make sure that your EBITDA is robust and ideally growing. If you go out trying to sell a hockey stick where the profit's been going like this and then suddenly it's going to take off, people aren't going to believe you. But you have to make sure that it's all very, very robust. And probably the financial buyers, the private equity houses, will spend more time tapping away at the numbers with a sharp instrument to try and find problems with them, because typically private equity will put in a bit of debt and they need to be able to guarantee that they're going to service that debt. Now, you might wonder why you'd want to deal with private equity, whether you're buying or selling. And the simple answer is this. At the moment, there are private equity houses have raised money, so it's committed capital, and that money has come from things like pension funds. And that the private equity community has what we call dry powder, so money that it's raised but hasn't invested yet. So it's got money sitting around waiting to go into businesses. And at the moment, globally, that dry powder is $2 trillion. And you might think, well, how much is $2 trillion? Well, it's the GDP of the United Arab Emirates, Norway, Singapore, and Switzerland combined, right? So it's a shitload of money. And bear in mind that they're going to put some debt in there. So it's sort of like 8 great big countries running around desperate to buy companies. And I mean, they are kind of desperate because if they don't use the money, they lose it. And also, they're paid for the upside. If they win, they get a share in the profits. So it's kind of like being sent to the casino with somebody else's checkbook, which is a great job to have. And by the way, until, in the UK at least, until about next month when Boris gets his way, they only pay 10% tax on the upside. I'm not bitter, obviously. But so you do have to deal with these people, and you do need to be aware of them. So if you're selling to them, you probably need to spend a bit more time doing some preparation. You should never, in my view, you should never ever do a deal without a proper lawyer on your side. And I'm not just saying that because we're sitting next to one another. And I'm not saying that because I don't think it's a good idea to chain them all up and put them in the ocean. But you do need them. They make a massive difference to the value you get if they know how to negotiate the contract properly. You also have to do proper due diligence, and that's no matter whether you're buying or selling. And a concept that came along in the mid-90s was vendor due diligence. Best way to explain that is, do you remember the home information packs? Right? I thought they were actually a good idea because it meant you could have lots of people bidding on your house and they didn't have to appoint a surveyor. But they just knew that it was all belt and braces, and that's what vendor due diligence does. And you'll get that from a firm of accountants. And it's worth investing in for all sorts of reasons that I won't bore you with at this point. But you have to make sure that when the bidders are on the other side of the table, whether the strategics or the financial, that they do not have any excuse to chip the price. And if you're acquiring, then you want to use good advisors, because you need to investigate the things that you need to investigate, and you don't want to spend time looking at stuff that's really not relevant. And if you're going to a firm of advisors, whichever aspect of the advisory community, it's always a good idea to get people that have been active in your industry before. And just to be clear, the kinds of advisors you need, as I say, you need legal, you'll need financial, quite often you need environmental when you're doing due diligence. If you're going to buy something that's been printing on the same site for 100 years, chances are there's something pretty unpleasant in the ground. So somebody needs to come along and poke some holes in it and tell you what it's going to cost to throw it over the fence. You may even need sort of a banking relationship if you're going to try and do it on the basis of debt rather than issuing equity. It sort of depends what your balance sheet looks like at the time. And what people like Moorgate do as corporate finance advisors, we're sort of like the overarching advisor that manages all the other relationships and makes sure that you get the answers you need when you're doing your deal, whether you're selling or buying. Managing the accountants that are doing the diligence and making sure that they don't get overexcited about undulations in pulp prices and raw material prices, because we all know that's all part and parcel of it. Steering them to where they actually need to spend their time, that's quite a valuable value add. And particularly corporate finance advisors, of course, help you with the valuation, and what you should pay and why. And also, most importantly, with the negotiations. So I think that's in a nutshell why you might want to work with advisors, and particularly corporate finance advisors.
Nick, just a quick question, in a nutshell, yes or no answer. Is there an appetite for people investing in the packaging industry in the UK at the moment?
I would say it's stronger than any time in 25 years. Certainly, when I started, I don't know how many of you ever picked up the pink paper, the Financial Times, but when I started 25 years ago, when you opened up the share price page, there was things like hotels, beverages, fags and something else, fags and tobacco, and then there was actually a section in the Financial Times for packaging companies. There was about 30 companies listed on the London Stock Exchange 25 years ago in the packaging sector. Now we've got, 3 or 4? Now, it's not that they've ceased to exist, it's just they've ceased to be public companies. Now, some of them were swallowed up by other public companies. I mean, RPC bought BPI, and then RPC was bought by itself. Sorry, that's plastic, not a good example. MY Holdings became part of Malbec. MY did some corrugated, as you probably remember, became part of Malbec in South Africa, and then the South African packaging industry consolidated, so it all became Nampak. Then Nampak sold the cartons bit to our client Platinum, and then we sold it to GPI and Essentra. So a lot of these companies have just disappeared, but that means there's a big opportunity for investors, because when there's private ownership, there tends to be more probability of a change of hands. Now, 2 reasons for that. One is obviously people retire or get divorced or pass away, unfortunately. So there's that kind of private company where at some point there will be an event that causes a business to change hands. But in the private equity type of private company environment, private equity typically invest in a business for 5 years, and then they need to sell it on to somebody so that they can put the money back into the pension pot that lent it to them in the first place or invested it in them in the first place. So with the private equity involvement, which is a substitute for the public company market listing, you've got assets trading hands. And it's very common to see a business that's been owned by private equity going on to another private equity house. And one reason for that is that typically private equity invest in a business, and then they'll support that business to go off and acquire other businesses, perhaps more parts of the UK to fill in the geographical footprint. And then when the next private equity house comes along, they may be looking at internationalizing the business, perhaps going to Western Europe, and then the next private equity house comes along and they're growing it into Eastern Europe or the Americas or something of that nature. So you typically see different types of private equity at different stages of a business's evolution. And it's just, the Germans think private equity is a plague of locusts, but I can tell you I've worked with a lot of private equity houses that have put a lot of money into businesses to grow them and develop them, because they know that if you do grow and develop, the business will be worth more when the next iteration of investment comes along.
Great, so a good time to contemplate selling your business, which is great. Okay, Jason, if I can ask you a question. What are the pitfalls of not engaging with professional services in the context of making an acquisition?
Well, first of all, if you don't engage the right people and you don't do the right homework, then you could end up wasting an awful lot of time and probably an awful lot of money as well. And the acquisition probably won't be as successful as it should have been. So it is key. I was involved in 2 transactions recently that were running alongside one another, and it was just a classic example.
Is your microphone on? I'll just double check that.
Sure. Lights on. Can you hear me? Yeah. So it was a classic example, really, as to what difference it can make if you've got a corporate finance advisor sat alongside you as a seller. And these 2 businesses, they weren't in the same market space, but they were both private companies. They were both selling for less than £10 million, so they're on the smaller end of the sort of mid-market private company sell. One was a great company with recurring revenue. The seller was caught on the hop a little bit because an acquisitive company came along, and they themselves are private equity backed on a buy and build strategy, and sophisticated. And put an offer to the chap that he thought, fantastic, I'm going to take this, and the deal's just what I want, so I'll crack on. And he spoke to his financial advisor, independent financial advisor, who pointed him in our direction. And we tried to get him some corporate finance advice, but he couldn't see the benefits for it. So he was selling his really nice little company with recurring revenue, and alongside that, at the same time, we were selling another company, which was a really scruffy thing. But the guy had been planning his retirement. He was selling his scruffy company. It'd been dressed very nicely for sale by the corporate finance advisor, and he achieved all his objectives, got a really nice price, and a deal that gave him the cash on completion that he wanted. Yes, a bit of earn-out afterwards, but frankly, it was at a level that it doesn't really matter. So if it happens, great. If not, no worries. The poor chap that had his decent company for sale that didn't take any advice, got screwed on price, got some very harsh terms that we tried as hard as we could to tell him to walk away from the deal, but by then he'd bought the boat and the new house, and was planning for his time in the sun. So, you know, it then goes without saying that you end up in a situation where you think, Christ, you could have done better. I do hope, and I'm telling you, and I told him in no uncertain terms, you know, I do hope you don't wake up the day after we sign this deal regretting what you're doing, because you're conceding an awful lot. And if he'd had a proper corporate finance advisor sat alongside him, you know, there's so much that a lawyer can do, and we can get involved in. As I said earlier, we get to know our clients well, and we roll our sleeves up and get stuck in there, and we will have those blunt conversations, as awkward as they can be sometimes. But the corporate finance advisor can dress the thing up in a way that the lawyers won't be able to, and they can get involved in the negotiations in a way that the lawyers won't be able to, and that can take out some of the emotion as well. And they become a go-between between the buyer and the seller and the principals there, and they won't have the wool pulled all over their eyes in the way that sellers sometimes can. Yeah. So it's absolutely key.
Good, thanks for that, Jason. So buyer and seller beware. If you're going to go alone, take some good advice. Okay, great. Tim, as the only person, because I don't have any money, on this panel who's got some money to invest in packaging businesses, what would you look for in the process of making an acquisition? What would you be looking for in a packaging company?
Yeah, I mean, I think it's worth just, for those who aren't familiar with the landscape, just outlining briefly the types of investors there are. And we're a kind of in-betweeny, I would say, in terms of trade and private equity. So let just.
Sorry, is your mic on?
I think
it
it's
is.
on.
That's right. Yeah, good.
So, you know, I think the thing that's missing, what I'm hearing that's key for us, because we look at small businesses, is the people element. And you know, for many people, their business is their baby. It's something they've developed over many years, and it's something that they care about deeply. For others, it's an asset. This is dependent on personality, of course, and it's something to be sold at the right price. So I think the type of buyer that you engage with, I don't think monikers are necessarily important. Are important depending on the person. in terms of what we do, very briefly, we kind of sit between buyers. We offer a kind of quasi-private equity option. So we have a number of fund of funds, both in the States and the UK, family offices, looking to deploy capital. And our model, very simply, is to buy small to medium-sized businesses that's somewhere in the range of 750k EBITDA. That's profit to around 4 million EBITDA, and to offer a solution in terms of management. Many people, we find, want to leave the business, and traditional private equity will ask them to remain with the business, particularly with small businesses where a lot of the expertise sits with the owner. And in our case, we look to actually come in and work with the owner over a transition period. Ideally, the owner, we'd love to stay and join as a NED, tax willing, and then we will operate the business in the medium term and then backfill with general management. So why do I say this? It's not really about us. It's more about saying, different owners will want different solutions. And I think, the first thing we look for, to your point, is someone that really knows what they want, because we see hundreds of companies and so many deals fall by the wayside when someone hasn't made a number of decisions. One of those decisions is emotionally is now the right time. There's a lot of competition in the market. There's a tremendous amount of dry powder, as you mentioned. But actually, the biggest competitor we find is the owner, and the owner wanting to potentially run a number of years more. If you're running a profitable company and you're enjoying what you're doing and you care about the company, very often, golf isn't there, or the beach we talked about, and the margaritas aren't where you see your next 5-10 years. And the big question is, do you sell, or do you continue in a very profitable company, living a good lifestyle, and look to do what you're thinking of doing later? So I'd start by saying, honestly, the first thing we look for is whether a seller, an owner, has come to that emotional point in their lives where they have made that transition. We've wasted a lot of time in deals which have actually fallen to pieces because the seller isn't ready. And for us, therefore, understanding the person that we're dealing with is key. I think the second thing for us, and again, this is how many flavors of investors there are, but is what is the owner looking for as a human being? Are they looking for a straight sale, the best possible price? Are they looking for a great price, but also the ability to leave the business? Are they looking to stay in the business, to keep shares in the business, and so on? So, the second thing I think for us, and we often have this conversation with owners and help them think about, what they want and what they need, is where do you see your relationship with the business going forward, and what is it that you want for the business? And if you want a great price, then I think any of these sellers, if they're going to give you a great price, are the right seller. If you want something which is going to give you sustainability for your staff and a great business, I think it's very important that you actually look very carefully at the buyer and who they are, what they bring, and what potentially their impact they will have on the business. So look, I mean, we've seen a number of reflections on what I've heard. We've seen businesses which have been in a real state historically and have got themselves together. And the key theme that we see more often than not, whether it's advised or it's not advised, usually it is advised, is kind of, if you planning the dive and diving the plan. 80% of getting your strategy done is having a great plan in place. And if you start 3 or 4 years in advance and you think, again, to that point, as a human being, this is what I want for my business, and these are the steps I need to take. Very often, if an advisor is involved, they can help guide you from a corporate finance perspective in terms of what you need to do to grow your business and help you think about strategic options that you may not have thought about. And that planning in advance gives you really the ability to get ready for a sale, and for some of the things we look for, and getting to the kind of the numbers now, the nitty gritty. It's pretty straightforward, but our flavour is definitely growth. Not everybody looks for growth, but for us, we are looking for a business which is either growing faster than GDP, or definitely has the potential to grow faster than GDP. There's a great story there. We're looking for a profitable business. We're not turnaround specialists. Again, there are as many flavours of investors as there are of ice creams. For our tastes, we look at businesses which are stable and reasonably profitable. They may have more room for expansion there, but they are growing, and they are growing profitably. And more importantly, to the point on planning, we look at businesses which are doing that with a historical stable record. So, for us to find a business which has had one great year because someone's woken up and decided they'd like to exit, and they've done a fantastic job of selling 5 to 10 big contracts. For us, that's not showing that kind of stable growth that we're looking for. And as has been mentioned, it's our flavour but not everybody's, and sometimes relevant in packaging but sometimes not. But we look for elements of recurring revenue. And recurring revenue in other industries is very highly valued. It also drives enormous value in a business. Recurring revenue could be contracted revenue, which I think is probably more rare for most of the businesses we're thinking about today, but it could also be stickiness in terms of customers, and that would look like year by year listing who your top 20 customers are. You would see the same top 20 customers appearing year on year.
Yeah.
So I think they're the main financial criteria, and then I just end by saying what other people have mentioned. The business can't just be you. If you're leaving a business, you're leaving a business hopefully with a great culture, but hopefully with staff that have the potential to develop into more senior positions and to lead the business or be led by others coming into the business. So, your position and that plan as to what the business is in terms of its dependence on you 3 years out is also very important.
Very
so,
good.
I just urge people to think very carefully about what they want. Work with corporate finance advisors and others to think about how that gels with what they want in terms of where the business should head well in advance, and find the right home and of course the right price for their baby.
Very good. Can we thank our panel members? I do have other questions, but we don't have time. So thank you very much, gentlemen. Thank you.